Welcome to this audio summary of Investing with Impact. Why Finance is a Force for Good by Jeremy K. Balkin. In this session, you'll discover how ethical finance, enlightened self-interest, and impact investing can turn capitalism into a powerful engine for social progress and shared prosperity. If you find this summary valuable, please take a moment to follow this channel, share it with a friend or colleague who cares about the future of finance, and hit like so more listeners can discover it. Your support helps me keep creating and publishing more audiobook-style summaries just like this one. So don't forget to subscribe and turn on notifications so you never miss a new release. Key concepts. Capitalism itself did not cause the 2008 global financial crisis. Rather, the crash stemmed from a breakdown in ethics and personal responsibility. Capitalism, when practiced rightly, has lifted more people out of poverty than any other economic system in history. Millennials, the generation that will soon lead Wall Street and global finance, place a higher value on social progress than on profit alone. They intuitively grasp enlightened self-interest, the economic expression of the golden rule, where doing right by others also advances one's own long-term interests. Public trust in both the financial sector and government has been deeply eroded. In this environment, it is the private sector, corporations, and private investors that holds the greatest potential to restore prosperity and rebuild confidence. Impact investing means selecting investments based on both financial returns and social outcomes, doing well by doing good. Simply excluding bad sectors is a limited strategy. Far more powerful is directing capital into investments that actively create positive change. The 6E paradigm, economics, employment, empowerment, education, ethics, and environment, offers a comprehensive way to assess the full social impact of an investment beyond just its environmental footprint. By quantifying the cost of unintended consequences, the 6E framework helps investors make more effective impact-focused decisions. The central challenge for finance is twofold. Extend banking and financial services to those at the base of the global economic pyramid, and democratize impact investing so people at all income levels can participate and benefit. Introduction. In Investing with Impact, Jeremy K. Balkin contends that the 2008 economic collapse was driven by moral failure, not by capitalism itself. He argues that what broke was not the free market, but the integrity of individuals operating inside a system that had already proven its power to lift billions out of poverty. The culture of modern finance, too, often rewards short-term wins and ignores long-term sustainability. That culture creates overwhelming temptations to greed, and it cannot be allowed to continue. The blame game. Balkin emphasizes that the global financial crisis is far too complex to be reduced to a slogan or a single villain. In this complexity, scapegoating feels satisfying. Blaming Wall Street or the government becomes an easy shortcut in our thinking. Deregulation fueled rapid expansion in banking, and resources were allocated in ways that ensured one stakeholder's gain often came at another's loss. As institutions grew larger, profits multiplied, executive bonuses soared, and personal gain became the incentive for ever riskier decisions. Some institutions became too big to fail, and a system that rewarded short-term gains helped hide the true scale of the risks being piled onto taxpayers, who ultimately paid for the bailouts. Balkin reminds us that the banking and financial sector plays one of the most critical roles in the entire economy. Finance is the business of matching ideas with capital and capital with great ideas. At its core, it is meant to be about progress, not decline. But to live up to that promise, the mindset on Wall Street must change. Markets must move away from their obsession with instant gains and refocus on long-term value. The industry must stop rewarding narrow, short-sighted greed and start celebrating the moral courage of those who invest with the intention to do good, those whose behavior is not just legal, but genuinely ethical. The problem, Balkin argues, lies not in capitalism, but in people. We all share a duty to work toward a better world, and it is people, not the system, who have failed. The version of capitalism that prevailed in the 30 years leading up to 2008 was a distortion, a culture in which many bore the risk so a few could reap the rewards. Such a culture is unsustainable. True capitalism is about investing in a way that allows others to benefit too. Individual greed caused the crash, and it must be confronted and constrained. Impact investing, using capital to empower others and lift them out of poverty, is the path to redemption. Consequences of the crisis. The moral failure that triggered the global financial crisis arose because people forgot the principle of enlightened self-interest, the recognition that what benefits society ultimately benefits the individual. In its place, a narrow, myopic greed took hold. Unenlightened self-interest. This dynamic echoes the tragedy of the commons, where individuals overuse shared resources for personal gain, ultimately exhausting those resources for everyone. Millennials have borne the brunt of these failures. Expected to support the older generation, many younger workers cannot find stable, well-paying jobs for themselves. They face record levels of disillusionment with government and major institutions, and many live in or near poverty. Financial insecurity delays marriage and family formation, weakens the family unit as a foundation of society, and contributes to persistently high levels of child poverty. Millennials see government as captured by special interests. They want a state that protects the vulnerable rather than the wealthy, one that guarantees economic opportunity without intruding on personal freedoms. Increasingly, they regard government as irrelevant at best. Having witnessed the damage wrought by unrestrained selfishness, millennials are, in many ways, more selfless than their parents. They volunteer more, and they embrace enlightened self-interest with greater conviction. Confident, skeptical of institutions and anti-establishment in outlook, they are ready to create a do-it-yourself prosperity. When asked to define the primary purpose of business, millennials place improving society slightly ahead of generating profit. This generation will eventually run Wall Street. If the financial sector clings to a culture devoid of social conscience, millennials will flow around it, circumvent it, or reinvent it altogether. Reimagining prosperity. Balkin argues that free markets are inherently positive when guided by enlightened self-interest, the golden rule applied to economics. Do to others as you would have them do to you. Countries that have experienced the most robust economic growth are also those where the incomes of the poorest have risen the fastest. With the notable exception of the oil-rich OPEC nations, the world's wealthiest countries are also its freest. Democracy and capitalism together safeguard political and economic freedom. Government's role is not to generate profit, but to remain limited and proportionate to the size of the economy. Since 2008, however, government intervention has often smothered private enterprise. Bureaucratic inefficiency and constant political turnover make the state a poor engine of wealth creation. When national debt exceeds roughly 80% of economic output, interest rates tend to rise, taxes follow, and a dangerous imbalance emerges. More people depend on state support than there are taxpayers to fund it. At that point, a slow downward slide into poverty can begin. The private sector must reclaim its rightful place as the driver of growth and prosperity. Capitalism provides the arena for earned success, and governments should encourage rather than restrain the productive power of private enterprise. The only durable escape from debt, funding shortages, and unemployment is sustained economic growth. Far from being the villain, capitalism has helped more people than the crisis ever harmed. People must abandon the zero-sum belief that one person can become rich only by making someone else poor. Instead, they must embrace enlightened self-interest. The rise of the sharing or trust economy, from ride-sharing platforms to peer-to-peer services, signals the emergence of a new paradigm. Today, among the world's 100 largest economic entities, 51 are corporations. These companies not only generate enormous economic value, they often outperform governments in implementing beneficial social policies. More and more, corporations seek not just financial capital, but social capital, as evidenced by the growth of corporate social responsibility programs. Critics of the free market often overlook enlightened self-interest. The private sector exists to promote human prosperity, just as finance exists to connect good ideas with the funding they deserve. When practiced authentically, free market capitalism remains the only viable path out of crisis and toward broad-based prosperity. Investing with impact. Balkin insists that doing well financially and doing good socially are not opposites. They can and should reinforce one another. Every investment produces both monetary and social effects, and responsible investors must weigh both. Yet traditional investment practice focuses almost exclusively on financial returns, distancing investors from their obligation to contribute to the common good. If every investor considered social impact alongside profits, global capital flows would look very different. More than 1 billion people have already escaped extreme poverty thanks to free market capitalism, whose profit-generating power remains unmatched. The finance industry must recognize this achievement and shift its culture from short-term selfishness to enlightened self-interest. Investors and institutions need to internalize the idea that money and social benefit can arise from the same decision, provided that the positive outcomes are visible and compelling. The potential social benefits of impact investing are vast. Fewer people in prison, healthier children, cleaner air and water, better infrastructure, more efficient government, and strong returns for investors. This is already happening in pockets around the world. The challenge is to demonstrate a consistent track record of profitability so that more capital flows into what could become a trillion-dollar market. Impact investing is one of the last truly scalable, global, and relatively underexploited investment frontiers. It offers the financial industry an opportunity to repair its damaged reputation and regain public trust. To realize this potential, impact investing must broaden its appeal. It needs to attract mainstream capital, not just niche, values-based investors. That requires sustainability in two senses. Investments must be profitable enough to draw growing amounts of capital, and leadership must come both from the top down and the bottom up. Ordinary investors must be able to participate meaningfully. In Balkin's view, impact investing represents a recalibration of Wall Street's moral compass back toward true north. Asset management firms need to take their accountability to stakeholders seriously. Many clients already insist that their funds be invested ethically. Traditional ethical investing, such as divesting from arms or tobacco, does reduce capital available to harmful industries, but its message is essentially negative, a boycott. Impact investing is equally ethical but more constructive. It can generate profits while actively encouraging other firms to adopt similar practices. As more investors join this movement, their collective influence grows. Financial firms that embrace impact investing will both do more good and earn more money, drawing still more investors and amplifying the effect. Investors already analyze risk and return. They must add a third dimension, social impact. Over time, investors will come to see that impact investing offers a double impact, earning financial returns while enhancing social well-being, which in turn fuels further investment and greater shared prosperity. The case for impact. The way mainstream finance ignored social impact and long-term sustainability contributed significantly to the 2008 crash. When investors did consider non-financial factors, they focused almost exclusively on environmental impact, which is relatively easy to measure. This made impact investing seem like a niche activity reserved for large foundations and ultra-wealthy individuals, rather than a practical option for everyday investors. In reality, every investment has ripple effects that can reach around the world. Imbalances in the global economy can create political instability and even war. Yet these systemic risks rarely factor into routine investment decisions, and they are seldom connected directly to social impact in investors' minds. Instead, the unintended consequences, known as externalities, are often blamed when markets fail. When governments respond with regulation, the system becomes even more complex and less transparent. Rising national debt fuels more taxation. Because direct income tax hikes are politically unpopular, governments increasingly regulate corporations instead, shifting costs onto businesses that then pass them on to consumers. The result is a hidden tax on average citizens. A more effective approach is to price externalities explicitly, turning them into measurable factors in investment analysis. With corporate social responsibility moving to center stage, stakeholders will soon expect companies to quantify their broader impacts. Firms that begin doing this early will gain a powerful advantage. However, traditional impact measurement, with its narrow emphasis on environmental harm and neglect of other externalities, is insufficient. To attract mainstream investors, the impact investing community must develop a broader system for evaluating impact and move beyond a simple money versus environment mindset. At the same time, governments are steadily tightening regulations around labor standards, ethics, and professional qualifications. Historically, such rules have brought rising, often hidden costs that are ultimately borne by consumers. The 6E paradigm. Balkin proposes the 6E paradigm as a structured tool to assess the social impact of any investment by making the unintended consequences visible, measurable, and objective. The paradigm rests on 6 pillars. 1. Economics. This covers the fundamental and technical analysis traditionally used to determine a company's value and share price. 2. Employment. Investments that create jobs, directly or through supply chains, benefit society in exponential ways, strengthening communities and lifting incomes. 3. Empowerment. This dimension looks at diversity and inclusion among a company's stakeholders, its employees, leaders, customers, and suppliers. Balkin notes that, in 2008, Wall Street's leadership was almost uniformly white, male, and drawn from a narrow set of elite universities. 4. Education. Companies that neglect training, learning, and professional development incur real costs over time in productivity, innovation, and compliance. 5. Ethics. Ethics reflect the moral core of corporate culture. Investors who want to contribute to the common good should direct their capital only toward firms whose leadership demonstrates high ethical standards. 6. Environment. A company's ecological footprint, its resource use, emissions, and broader impact on the planet remains a vital part of the equation. Starbucks offers a practical illustration of the 6E paradigm at work. 1. Economics. Since its initial public offering, Starbucks stock has appreciated dramatically, rising by many thousands of % and rewarding long-term shareholders. 2. Employment. The company refers to employees as partners, and even part-time workers who meet a modest hours threshold receive benefits, signaling a commitment to their well-being. 3. Empowerment. Starbucks has cultivated strong diversity throughout the organization, from frontline staff to leadership. 4. Education. The firm funds individual scholarships to Arizona State University online, without obligating recipients to continue working for Starbucks afterward. 5. Ethics. Starbucks applies rigorous ethical standards across its supply chain. In 2013, more than 95% of its coffee was ethically sourced, with a stated goal of reaching 100%. 6. Environment. The company promotes reuse and recycling of paper products and has already cut its water consumption significantly. If widely adopted, the 6E paradigm could open the door for mainstream investors to practice impact investing in a practical, scalable way. Because it can be applied across all asset classes, particularly in liquid public equity markets, it offers investors more choice and better insight. By embedding 6E thinking into stock analysis, the paradigm has the potential to transform the impact investing industry and align liquidity with long-term social value. Finance as a force for good. The more capital flows into impact investing, the more powerful finance becomes as a tool for positive change. Yet today, roughly a third of the world's population cannot participate in formal investing at all because they lack access to regulated financial institutions. Instead, they turn to the informal or black market financial system, a multi-trillion-dollar shadow economy that often bankrolls organized crime and terrorism. Microfinance helps bridge this gap by extending very small loans to people who would otherwise be excluded from banking. This is not just an issue in developing countries. In advanced economies, too, distrust of the financial system after the crisis has left many people effectively unbanked. Investing in microfinance institutions is a promising impact opportunity, but it is only one piece of a larger puzzle. Public-private partnerships, philanthropy, equity investments, and shareholder activism all have roles to play. Infrastructure investment is another powerful lever for impact. Building and upgrading infrastructure creates jobs, boosts regional economic output, and delivers long-term social benefits. Despite this, U.S. infrastructure remains severely underfunded. As an asset class, infrastructure has the potential to generate trillions of dollars in value. The private sector has both the motivation and the capital to build better, cheaper, and faster, yet governments often resist privatization. While the United States has tentatively experimented with some public-private partnerships, there remains a substantial gap between stated intentions and actual practice. Because they target narrow issues, traditional aid channels, charity, government programs, and even social impact bonds collectively have less transformative potential than large-scale infrastructure investing. For institutions and pension funds, infrastructure is particularly attractive. Projects are long-term, enjoy quasi-monopolistic advantages, and are less sensitive to short-term market volatility. Private sector investment in infrastructure allows governments to shed poorly managed, non-core assets while raising tax revenue from the broader prosperity that follows. Social impact bonds offer another innovative approach, aligning governments, nonprofits, and private investors around clearly defined social goals. Investors are paid only if agreed outcomes are achieved, aligning incentives with real-world results. Currently, this space is dominated by wealthy individuals and major institutions. But by matching the risk-return profiles of smaller projects with those of individual investors, participation could be broadened to include less affluent savers. Philanthropy, too, could be reimagined as an asset class. Today, nonprofits spend enormous time and energy chasing annual grants. Funding often flows to the organizations with the most persuasive grant writers rather than the most effective programs. Once money is awarded, organizations feel pressure to spend it all quickly to avoid future cuts, and many foundations are named more for donors than for causes, leading to duplication and inefficiency. Partnerships between businesses and nonprofits could transform this landscape by introducing transparency, performance measurement, and rigorous management practices. Treating philanthropic capital more like investment capital would allow donors to invest in social outcomes rather than simply give, receiving some form of return, whether financial, reputational, or in measurable impact. Over time, investments tend to be more sustainable than one-off gifts. Most individual investors confine themselves to familiar instruments like home equity, bonds, and broad stock indices. Yet public equity markets are large, liquid, and transparent, a fertile arena for impact investing. The 6E paradigm can help investors make better, more values-aligned choices in these markets. Pension funds, the largest pools of capital, may face restrictions on which assets they can buy, but 6E offers a way for pension savers, retail investors, mutual funds, and others to do well by doing good within existing constraints. The U.S. stock market, the largest in the world, provides ample space to design innovative, impact-focused financial products. As these offerings attract assets, investors can make socially responsible choices without sacrificing performance. That, in turn, gives corporate executives a strong incentive to behave more responsibly, socially, and environmentally. In politics, voters hold the ultimate power. In finance, that role belongs to investors. When impact investing becomes a bottom-up movement driven by everyday savers and shareholders, its influence will be greatest. One common form of investor activism is to accumulate large stakes in companies and then press management or boards for change, often in response to mismanagement. Activist hedge funds, for example, have outperformed broad indices even in the aftermath of the 2008 crash, proving that activism and returns can go hand in hand. A growing number of shareholders now demand socially responsible behavior from the companies they own. They challenge the idea that profit is the only goal, pushing leaders to balance financial results with social and environmental responsibilities. So far, environmental activism by stakeholders has had mixed success, but even limited progress has often outpaced government efforts. Having energy use and emissions appear clearly as line items on corporate financial statements would intensify pressure to reduce them, making companies greener in both senses, environmentally and financially. Today, the overwhelming majority of large companies have already shown that cutting emissions can actually create value. Conclusion: we the people. For many, capitalism remains a metaphor for freedom itself, an economic system that, through enlightened self-interest, empowers people to choose in ways that benefit the common good. Around the world, free markets tend to coexist with freedoms of speech, religion, association, movement, and ideas. Yet unethical conduct at the top of the financial and political hierarchies has led to disaster. Income and wealth gaps have widened dramatically, and real wages for ordinary workers have stagnated for decades. Ultra-low interest rates have disproportionately benefited those who least needed help. Today, a tiny elite of the richest individuals holds as much wealth as billions of the poorest people combined. Paradoxically, inequality in both income and opportunity is often more extreme in developed countries, where economic growth now depends even more on a healthy private sector. The key to creating jobs and broad-based prosperity lies in the ability of the banking and finance sector to facilitate the flow of capital. Impact investing, however, is still viewed by many as an abstract concept discussed more than practiced. There is a pressing need for accountability to close the gap between rhetoric and reality. At present, the impact investing conversation has focused heavily on social impact bonds, which, while promising, remain relatively small, complex to structure, and accessible only to a narrow group of players. In a world where governments move slowly and often reluctantly, impact investing must be democratized. By 2050, the global population is expected to reach 9.5 billion, with a majority living in poverty if current trends continue. Government programs have repeatedly fallen short in alleviating poverty at scale. The private sector, guided by impact investing principles, offers a more sustainable path to universal prosperity. Because the financial industry controls access to capital, impact investing must become a core value on Wall Street, not a peripheral experiment. Demographics underscore the urgency. By 2020, over 100 million millennials in the United States alone were on track to form more than a third of the adult population, around 40% of eligible voters, and over half the workforce. The financial industry must show this generation that Wall Street is committed to improving society, not just enriching insiders. The world cannot afford to wait.